Good morning. Happy New Year. Welcome to Good to Know Talk series, where our focus is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janine Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. This morning, we have James Kaw on the line. James is a financial advisor at Edward Jones, and he's my trusted source for information in the industry. He's here to answer questions and offer his expertise. James, good morning. Are you there? Thanks for being with us this morning. Maybe I can't hear you. Well, we can check in with,
Okay, I unmuted myself. Can you hear me now?
Oh, yeah, good morning.
Okay, good morning. How are you, Janine?
I'm good. You had a nice weekend?
Yes, besides the missile scare, yes, everything else was good.
Yeah.
I had my family, my parents are meeting. They were visiting from Seattle, and they picked just the right weekend to get a little scare out of their vacation. So yeah, that's pretty interesting.
Yeah, grateful that we're all still here. Yeah, at least it was, survived that one.
Yeah. But no, thanks for having me. Yeah, if there's any questions along the way that anyone has, I'll be muted, but then I'll try to unmute myself and be a resource for anything, any questions that anyone may have.
Okay, great. Thank you.
Yep.
So today we continue part 2 of the business portion of the Tax Cuts and Jobs Act. If you missed last week, feel free to email us at info@smarttaxhawaii, and we'll send you a copy of that recording. So last week we discussed the new kind of income that is mentioned in this new law, and it's called the qualified business income. We talked about how it's calculated and some strategies to maximize its deduction. My slide is moving a little slow. Here we go. Yeah, so we talked about the qualified business income and how it's calculated. So it's last week's episode, if you can request a copy, there's some great strategies that we went over on maximizing the 20% deduction that this new law enacts. And always, when we're talking about with this new tax law, just to keep in mind the 4 keys to cutting tax. And, I've talked about this before. So the first strategy is timing-based strategy, like using a 401k deferral to shift today's tax bill to tomorrow. There's also the income shifting strategies, such as moving taxable income to lower bracket taxpayers like your children. We have code-based strategies, for example, Section 105B that lets you deduct your family's medical bills as a business expense. And lastly, we have product-based strategies like separate managed accounts and insurance. But you'll find that most of the new law's changes fall under the code-based strategy. So today I want to talk about some specific business deductions, and I want to start with depreciation and expensing. So here's the basic concept. Traditionally, when you buy something durable, like a building or a truck or machinery for your business, you don't get to just deduct it right away. You have to deduct it over time, a period of time that approximates the useful life of the property. This process is called depreciation. To depreciate property, the first thing you need to know is your basis, which usually just means how much it costs. The next thing you need to know is the recovery period or life. So most machinery and equipment is 5-year property or 7-year property, which means you write it off over 5 years or 7 years. Land improvements like driveways and parking lots are generally 15-year property. Residential real estate depreciates over 27.5 years. And finally, non-residential real estate or commercial property depreciates over 39 years. The next thing you need to know is what method to use. So some property depreciates over a straight line, which means, for example, real estate, you divide the basis by the recovery period of 27.5 years, or 39 years if it's a commercial property. So if you buy an office building for $390,000, you're going to deduct $10,000 per year. But most property qualifies for some form of accelerated depreciation, which basically lets you write off more in the early years. There's the 200% declining balance, there's 150% declining balance, and some property even switches from one method to another once you reach a certain point. I won't go into any more detail than that. And finally, you need to know which convention to use. The rationale here is that unless you buy something on January 1st, you shouldn't get to deduct an entire year's worth of depreciation that year. So there's a half a year convention, mid-quarter convention, and even mid-month convention, depending on what you're buying. Does this all make your head hurt a little? But there's more. There's a few more complications. First, the tax code lets you take bonus depreciation, which means the year you buy something, you can take bonus depreciation the year you buy it. So for example, if you bought a car for your business between September 2010 and January 2014, you could deduct an extra $8,000 the year you bought it. If you bought equipment, you could deduct 50% off the top and then depreciate the remaining 50% over the recovery period. Second, the law also lets some property qualify for first year expensing, which lets you deduct it outright. So rather than depreciating it over time. For 2017, you could expense up to $500,000 of tangible personal property, whether it was new or used, except for most passenger vehicles. Now, why complicate things with bonus depreciation and first year expensing? Well, the goal here is to stimulate the economy by making it easier for businesses to buy equipment and grow. Now, you've probably figured out why we're walking through all of these rules. The Tax Cuts and Jobs Act lets you take 100% bonus depreciation on any qualified property you place in service after September 2017. This percentage then drops to 80% for property you buy in 2023, and then 60% for property you buy in 2024, and it continues on. So when I talk about qualified property here, it means anything except real estate and land improvements. Now, this might not sound like much after all the talk. I know that I'm giving you a lot of details about basis, recovery periods, and conventions, but trust me when I say that this is a big deal. It really will make buying stuff for your business easier to afford as well as easier to account for. Of course, what one hand gives, the other sometimes takes away. So traditionally, businesses have been able to write off an unlimited amount of interest they use to finance the assets we just talked about depreciating. You may have heard that the new law limits these deductions for business interests, which is true. But those limits aren't likely to affect most of you. For starters, the limits don't apply unless your business averages $25 million or more in gross receipts. And even then, you can still deduct interest up to whatever amount of interest you earn plus 30% of your adjusted taxable income. And finally, you can actually carry forward any disallowed interest deduction as long as you need. Domestic production activities. We've said before that Washington uses the tax code to do lots more than just raise revenue. One of those goals is encouraging manufacturing here as opposed to overseas. So in 2004, Washington created the Domestic Production Activities Deduction, which generally gives you 9% of the income you earn, gives you a 9% deduction of the income you earn from domestic manufacturing. However, the new law repeals this deduction. Another change you probably won't like is with business entertainment. Under the old rules, you could deduct 50% of the cost of any entertainment expense that took place directly before or after a substantial business activity. So these are deductions that include, if you bought tickets for a sporting event, any food, parking, anything that was before, during, or after a business-related activity. This new law repeals that deduction, regardless of what business entity you operate. The new law also tightens the rules for deducting business meals. So previously, under the old law, you could deduct 100% of the cost of providing food and drinks to your employees. However, the new law now cuts that deduction to just 50%. There's still little gray areas in this section of the code. So if you have questions, please feel free to reach out to me so we can clarify how it applies to your specific business. There are a few under the radar parts of this new law that I thought was worth mentioning. The first one actually may be a welcome step for all the survivors of sexual harassment who fought so hard for their rights. This bill denies any deduction for a settlement, payout, or attorney fees related to sexual harassment, as long as the settlement includes a non-disclosure agreement. Net operating losses. In an ideal world, of course, your business would make money year after year and lots of it. But, we don't live in an ideal world. And sometimes businesses lose money. So if a taxpayer, meaning a business owner, whether a C Corp or a pass-through business, if you lose money in a year, that loss is called a net operating loss. And while nobody wants to lose money, a net operating loss doesn't just get wasted. It can actually help you save tax in a different year. Under the old rules, if you had an NOL, you could carry it back for up to 2 years and get a refund. Or you could carry it forward up to 20 years. And this actually might make sense, especially if you're expecting to be in a higher tax bracket in later years. So the new law makes 3 changes to net operating losses. First, it eliminates the 2-year carryback period. Well, I have to mention, except for farming businesses and property insurance companies. I'm not quite sure how that happened, but for most businesses, you're not allowed to carry back your net operating losses anymore. However, you are allowed to carry it forward indefinitely. So rather than being limited to just 20 years, you can now carry it forward indefinitely. Estate taxes. Benjamin Franklin once said, the only certain things in life are death and taxes. And that was before we had an estate tax. Under the old law, Effective in 2011, estates were subject to a 40% tax. However, there was a $5 million per person unified credit, which basically meant that only 2 out of every 1,000 estate actually paid the tax. The easy solution to avoiding estate tax, if your net worth was above this threshold, was to, just give it away. But the IRS is way ahead of you here, which is why there's a gift tax. Under the old law, you could give up to $14,000 per year to anyone you want without any gift tax consequence. If you're married, you and your spouse can make gifts of up to $28,000 per person. So there's some bad news and some good news. The bad news is the estate tax lives on. The House bill would have eliminated it entirely, but that proposal just cost too much, so it didn't make the final cut. The good news is the new law doubles the unified credit to $11.2 million per person. And then it's also worth mentioning that for 2018, the annual gift exclusion rises to $15,000 per person, which is above the $14,000 what it was in 2017. And that actually has nothing to do with the new law. It's just a result of inflation. There's a few, changes in the law that don't quite fit neatly in the business section, and they don't even really fit neatly in the personal section, but I thought I would mention it. There's some changes that one of the new changes, it incorporates it's called the Craft Beverage Modernization and Tax Reform Act. Basically, this means your alcohol will be cheaper. The federal excise tax on beer drops from $18 to $16. The law also expands the excise tax credit for larger wineries, and it lets sparkling wines qualify. And it also reduces the federal excise tax on distilled spirits, which currently stands at $13.50 per gallon, and it drops it down to $2.70 for the first $100,000. I'm sorry, for the first 100,000 proof gallons. Kind of an interesting thing in this new tax law. Another thing that deduction that actually went away with the tax law was under the old law, Code Section 162 said that members of Congress could deduct up to $3,000 per year for living expenses while they're away from their districts. But the new law eliminates this deduction. This one might actually seem a little petty. Under the old law, you could exclude a whopping $20 per month for expenses related to riding your bike to work, so long as you weren't receiving other transit benefits. However, the new law eliminates that benefit. And how much will letting the air out of this brake save the Treasury? Well, for you Austin Power fans, say it with me, $1 million. A whole $1 million a year in new revenue, a rounding error at best. And just to compare, car commuters cost the Treasury $8.6 billion per year. So eliminating this deduction will raise $1 million for the Treasury. Let's see, a final provision that you may have heard about the bill is that it somehow repeals Obamacare. One of Obamacare's central components is the individual mandate. And this is the requirement that every American carry health insurance, or you pay a fine, and you pay this fine when you file your tax returns. So for 2017, that penalty is $695 per adult and $347 per child. The Tax Cuts and Jobs Act doesn't actually repeal that individual mandate. What it does is it reduces that penalty to zero. And this is for 2019 and beyond. However, it doesn't repeal the Obamacare employer mandate. It doesn't repeal the exchanges, the coverage and benefits, or any of the other Obamacare provisions. The only thing it did repeal was it reduced the penalty down from $695 per adult down to $0. And this is in effect starting from 2019. Colleges and universities have traditionally taken gifts from alumni, parents, and other supporters, and use them to build endowments to generate income to build and maintain facilities, hire faculty, and also to offer discount tuition for needy students. Schools generally qualify as nonprofit charities, so there's no tax on their earnings. Well, at least until now. The new law imposes a 1.4% tax on earnings from the very richest schools. These are private schools with over 500 students and endowments over $500,000 per student. It should only affect a few dozen schools, mostly Ivy League names like Harvard and Princeton. And the tax itself is only expected to raise about $1.8 billion over the next 10 years. So at first glance, this new tax looks a little bit more like a rounding error than a real threat. But, for example, Princeton University's endowment is $22.2 billion, which works out to about $2.5 million per student. If the fund earns 8% per year, that 1.4% rate works out to just under $25 million in tax. But that's over $3,000 per student, which is significant. Right now, Princeton uses that endowment to admit students without considering whether they can afford it or not. Students from families earning under $65,000 pay no tuition, room, or board. And 82% of Princeton students actually graduate debt-free. And the average debt for those who do borrow is just under $9,000. So somebody is going to lose out because of the tax. And Princeton's endowment per student is the highest in the country, with 5 times the amount per student as the threshold of the tax. But who knows what effect it will have on schools without the same type of resources. And then there's this provision that has absolutely nothing to do with taxes. Well, at least not directly. The Alaska National Wildlife Refuge includes 19.2 million acres in the far northeast corner of Alaska. To call it remote would be an understatement. But it's also home to more plant and animal species than any other protected area in the Arctic Circle. It has, animals including over 100,000 caribou, moose, bears, wolves, birds. Back in 1977, Washington banned drilling for oil in this area. But ever since then, energy industry forces have worked to allow drilling in a 1.5 million acre subsection of coastline, and it's known as the 1002 area. Well, the Tax Cuts and Jobs Act directs the Department of the Interior, which manages Alaska National Wildlife Refuge, to hold lease sales in this 1002 area, which they estimate contains 11.8 billion barrels of technically recoverable crude oil. The law doesn't mean that drilling will start anytime soon. I'm sure there'll be a lot of scrutiny, permit reviews and plenty of lawsuits. It may be a decade before drilling actually starts, if ever, but the new law at least opens the door to that possibility. So you, as we've gone through, last week and this week, you can see that there are a lot of moving parts, especially for business owners. And there are a lot of opportunities you have to plan for to take advantage of. And I just want to mention, that's where we come in. We offer true proactive tax planning to help you make the most of the new tax law and to catch up on opportunities you may have missed under this new tax law. And the process really works like going to the doctor. If you're sick, the doctor starts with the diagnosis, what's causing the pain, then he prescribes a solution. Maybe it's a prescription, surgery, physical therapy. Finally, someone is going to fill that prescription. Well, we work the same way. We start by sitting down with you for a free tax analysis where I'll review your returns and look for any missed opportunities. And then we prescribe a solution. And sometimes that means restructuring your business entity, implementing a new strategy, or just even rescuing lost depreciation dollars. Sometimes my company will fill this prescription, and other times we'll bring in a network of specialty vendors. Like James Kaw, who offers, services on, financial planning. We have also other vendors that offer, cost segregation studies. If you want to look into captive insurance management, even charitable trusts. So, I can't tell you how much we're going to save until we sit down with you. But I can tell you that a lot of business owners are wasting thousands of dollars every year in taxes. Please, if you have any questions or you want the tax diagnosis, please feel free to reach out to me at info@smarttaxhawaii.com. And let's see, I'm looking to see if there was any questions. Don't think I see any questions. Well, and we're actually at the end of our time today. That was a quick that was a quick 30 minutes. I appreciate your time.
I have one question or one clarification, Janine.
Mm-hmm.
So as you stated, 50% of entertainment, I guess, expenses could be deducted before. And then with the new tax reform or tax law, is it permanent that, or is it just going to be a temporary change for that 50%? So at some point in the future, would it potentially go back to that 50% of entertainment could be deducted?
No, it's permanent.
Okay, it is permanent. Okay, and then same thing with the cost of food, that is permanent as well.
Right. Yeah.
Okay. Now, since we're giving up a little bit with that, as business owners, where are we, is there any benefit to the flip side of the coin? Because for me, in taking out clients or, just throughout the day traveling and, having to spend on food, where is the benefit? Is there any benefit on the flip side?
There is. So, last week we had talked about that the new law offers a 20% deduction of your qualified business income. So that was supposed to offset some of these other loss deductions.
Mm-hmm.
Yeah.
Got it. Okay. Thanks for the clarification.
Mm-hmm. Okay, well, thank you again for tuning in. Next week, I will be talking about the personal aspects of this new tax law and how it will affect you. So if anything, you can always email us at info@smarttaxhawaii.com. Other than that, we look forward to next week, same time, same place, and have a great week. Thank you.
All right. Thanks, Janine.